You can feel safe right up until the exact moment your safe investment becomes a liability. And in the next 3 months, millions of people will learn that the foundation of the modern wealth system is not productivity, not innovation, and not even hard work. It is timing, leverage, and governments choosing which pain to let you feel. This is not financial advice, this is financial education. But I am going to say something cold and specific. The first step of this coming squeeze is not just the dollar weakening. The real execution happens when the calendar forces the United States to roll enormous debt at much higher interest rates, while global liquidity and confidence are already fragile. That is when markets stop behaving like markets and start behaving like panic machines. If you are watching this in 2026, you already know the vibe. Artificial intelligence is ripping through office work and mid-level jobs. Employers are restructuring and calling it efficiency. Housing is still divorced from wages in the United States, the United Kingdom, Canada, and Australia. Even when inflation prints cool numbers on paper, your paycheck buys less than it did before. Meanwhile, stocks keep flirting with highs, as if the real world is an optional add-on. And if you think that disconnect is an accident, you have never studied how wealth gets transferred during stress. So today I am going to walk you through a mechanism that most people never learn until it is too late. We are going to start with a debt deadline that lands in late June. We are going to unpack why the interest rate shift from almost free money to about 4.5% changes everything. We are going to cover why the United States Treasury market can stop functioning like a safety asset and start acting like a crack in concrete. And then we will connect it to your life in 2026, the rising cost of borrowing, the retirement math, and the fact that when the system panics, the people who lose first are the ones with the least leverage. The story starts with a number so big it stops sounding real. Late June is when the United States faces repayment pressures around $6.5 trillion. Think about what that means. That is not a small refinancing event. That is not a routine rollover you ignore. That is an enormous mass of obligations that were originally financed when the world was in crisis. Interest rates were suppressed, and the Federal Reserve was actively expanding its balance sheet and pushing money into financial conditions. During the pandemic years, the political goal was simple: keep the system from freezing. The market goal was also simple: preserve liquidity. The result was that a lot of government debt issued then carried extremely low yields. Many of those instruments, in effect, matured into a moment where the price of waiting becomes enormous. Now the calendar arrives. Now the old low-rate obligations have to be paid back or refinanced. And here is the part nobody wants to say out loud: you cannot refinance your way out of higher rates forever when the underlying cash buffer is shrinking. According to the structure of how the Treasury manages cash and issuance, the government's near-term cash balance is not some infinite vault. It is measured in hundreds of billions, not trillions, relative to the upcoming maturity load. So the practical constraint becomes obvious. When the Treasury needs to meet obligations, and the cash pile is not big enough, it must borrow again. But now comes the mechanical cruelty. Borrowing conditions in 2024 and 2025, and into 2026, have shifted. The Fed has kept policy rates higher than the near-zero environment of the pandemic. That means new borrowing is not cheap. It is around 4.5% in the simplified framing that matters for the debt transfer problem. 4.5% does not sound like a disaster if you are imagining a personal loan. It becomes a catastrophe when the principal is trillions and the market has to absorb issuance under stress. Let me give you a micro story, because abstract numbers do not haunt you. People do. Picture a 39-year-old nurse named David in Phoenix. He worked overtime through the pandemic. He bought a used car with cash because he hated debt. In 2021, he refied his student loans at a rate that felt manageable. He did everything right by the usual rules. Then his landlord raised rent again. Food costs stayed higher than he expected. And then 1 year later, he learned something quietly brutal. Inflation came down in some headlines, but his purchasing power never recovered. Now imagine David also co-signed a debt with the government itself. Imagine his job is not to repay the debt, but to watch the terms reset every time the calendar forces maturity. In a household, you might feel it when credit cards jump rates. At national scale, you feel it when the cost of servicing new debt rises. And when servicing cost rises, something has to pay. Either taxes rise, spending falls, or the Fed and the Treasury coordinate in ways that keep the system from breaking. In households, the escape route is usually credit. In countries, the escape route is usually the central bank. So why does the central bank matter? Because of the next layer: who is willing to lend at these new yields. Debt rollover is not only about the government needing money, it is about the market's willingness to absorb the issuance. Under the old setup, plenty of investors were willing to buy United States Treasuries even at low yields because those bonds offered stability and because for years the market price generally rose. Investors could lend, hold the bond, and benefit from price increases. The bond behaved like a safety asset that also had a speculative tailwind. In other words, you could earn yield and also earn capital gains if the bond market kept moving the way it had been trained to move. Now imagine you are a bank. You lend against treasuries using leverage. You do it because your customer brings you a bond, you give them cash, you collect fees, and the bond price has historically been supportive. But leverage turns every small decline into a forced sale. Leverage turns paper losses into liquidation. And liquidation turns a normal market into a cascade. This is the hidden reason why stress events become self-fulfilling. When bond prices fall, collateral values fall. When collateral values fall, margin calls show up. When margin calls show up, someone sells. When someone sells, prices fall more. That is not philosophy. That is plumbing. After 2020, the bond market's behavior changed. Treasuries had periods of drawdown, and from the perspective of leveraged positions, those drawdowns were not normal volatility. They were damage. Add foreign selling and the picture worsens. Large holders can decide that the risk return is not worth the exposure, even if they are not trying to destroy the system. They just rebalance. And when someone else is holding your collateral and they sell, you feel it immediately. Now bring this back to your life in 2026. You are not trading treasuries. You are trying to pay for rent, groceries, healthcare, and maybe a mortgage if you are lucky enough to qualify. You are trying to keep your retirement plan alive in a world where the retirement age keeps creeping upward and underfunded pensions are exposed every time a market dips. You are watching automation eat tasks and watching job descriptions quietly remove human from the workflow. So ask yourself a question. If the financial engine is built on rollover confidence, what happens when confidence is damaged and borrowing costs rise? It does not stay inside finance. It leaks into everything. Higher interest rates mean more expensive financing for businesses. More expensive financing means some companies delay expansion, some lay off staff, and some fail. Higher rates also mean the government has higher interest expense. That can reduce room for fiscal spending later, especially when voters demand services but budgets do not stretch. And here is the dark humor of modern economics. For years, ordinary people were lectured to save, invest, and be responsible. Then the system trained you to believe that you were one emergency away from stability. Meanwhile, the people who actually control leverage can move first, hedge first, and sell first. This is why stock prices can seem disconnected from reality. It is not because the market is stupid. It is because the market is a discounting machine for whoever is positioned to benefit from the policy path. When the Federal Reserve signals, and when institutions expect liquidity support, assets can rally even while regular workers feel like they are losing. And then comes the moment where the calendar forces decisions. During the next phase, the United States faces a choice. It can try to roll debt without massive central bank intervention, hoping investors will calmly absorb issuance at higher yields. Or it can rely on the Fed to keep the Treasury market functional by ensuring demand and liquidity. When demand is insufficient, yields can jump, prices can fall, and collateral can break. When collateral breaks, credit spreads widen, and suddenly the entire economy feels the shock. You do not need a conspiracy, you need mechanics. The system is interconnected. When one part stops functioning, other parts compensate until they cannot. So what does the Fed do when market stress becomes unmanageable? In past crises, the answer has always been expansion of balance sheet and liquidity injection. During the financial crisis of 2008, and again during the pandemic crisis of 2020, the Fed and its counterparts expanded monetary capacity to stabilize markets. The goal was not to help people. The goal was to stop the plumbing from freezing. If you want a ruthless but accurate translation, they saved the system first, then they let the mess trickle down with delays in conditions and inflation residue. But 2026 is different in one critical way. The world is not starting from calm equilibrium. Global debt levels exceed $300 trillion. Insurance markets have been disrupted by climate-driven disasters. Migration costs and adaptation spending rise even when budgets are strained, and governments face political pressure while central banks face credibility pressure. That combination makes every crisis more complicated. In that environment, rolling a $6.5 trillion obligation is not just a Treasury accounting event, it is a confidence event. The market will ask, will the Fed support demand if yields rise too fast? Will liquidity be provided quickly enough? Will inflation re-accelerate if support becomes aggressive? Will the dollar weaken as a result? And here is the part where the mechanism gets ugly for everyone holding cash and average employment income. When the dollar weakens, the cost of imports rises, commodities move, and real purchasing power erodes. Even if the official inflation rate looks better later, your real life may not improve. You feel the lag, you feel the adjustment. In many countries, home affordability has already collapsed relative to wages. That collapse is not temporary. Housing is a long-duration asset, and when financing costs and supply constraints stay elevated, affordability can stay broken for years. People who cannot buy become permanent renters. People who are renters get squeezed again and again. So when the dollar weakens and global assets reprice, the effects are not equal. If you have stable assets, or you have income tied to rising prices, you can ride it out. If you have debt with fixed payments, you may even benefit in nominal terms. If you have savings that earn low interest while inflation eats them, you lose slowly. And if you are leveraged, you lose quickly. Now let us go deeper into why some people believe the next crisis can produce opportunities for those who are prepared. I am not going to tell you how to profit. I am going to explain the logic. When markets panic, they often sell everything together. Stocks drop, high-yield credit spreads widen, bond prices move violently, and liquidity evaporates. That forced selling can create mispricings. Then, when stabilization arrives, risk assets can rebound sharply. The people positioned to buy during the worst price dislocations can benefit if liquidity returns and confidence stabilizes. But most ordinary investors do the opposite. They sell at the bottom because fear overrides process. Or they hold through a collapse and hope for a recovery that never arrives in the time frame they needed. In 2026, that behavioral problem is intensified by social media. You see passive income creators selling fantasy. You see AI-generated content telling you that the market always goes back up. You see people confusing survival with success. In reality, if you cannot survive long enough, you do not get the rebound. You are not just investing, you are managing life. So remember David the nurse. He is not trading. He is making rent. He is paying bills. He is deciding whether to take a second job. He is not waiting for the chart to recover. He needs stability now. If a financial shock hits payroll budgets and credit availability tightens, he feels it through employment hours and healthcare costs first. That is the human part. Now we connect it to the international part. In the late-stage crisis setup, when Treasury market confidence is threatened, global holders of dollars and treasuries face a dilemma. If they believe the Fed will eventually devalue through currency weakness or through policy accommodation, they might shift into alternative stores of value. That can push the dollar down. And if the dollar goes down, the world scrambles. A weaker dollar can sound like a macro concept. In reality, it is imported inflation, it is commodity repricing, and it is the price of energy and food showing up in your budget. Meanwhile, some assets can rise, especially those viewed as hedges. That is why, during periods of stress, gold often attracts attention. Gold does not require trust in a specific issuer's future cash flows. It is a different kind of risk. It is still a market, but its role changes under fear. Now here is a brutal nuance. The United States is not only a borrower, it also holds enormous gold reserves, and it also has complex relationships with foreign gold stored and mobilized through international arrangements. So if gold rises, it can be framed as a hedge story. But from a sovereign perspective, it can also be part of the balance sheet narrative during stress. You might think, if gold rises, does that mean the United States is losing? Not necessarily. If the sovereign owns gold, price gains can offset currency losses in the accounting sense. This is not magic. It is bookkeeping under market stress. And bookkeeping is often how policy arguments get constructed. But the core issue remains. What happens to the dollar and to financial assets when the debt rollover pressure peaks? The system may attempt to manage the shock by adjusting policy expectations. But managing the shock can also mean coordinating money creation and market liquidity in ways that weaken the currency. So do we get chaos or stability? History says both can happen, but in a specific sequence. Before previous crises, large investors often rotated risk, positioning themselves to profit during forced selling. During the crisis, the market sells. After stabilization, the market buys. Then wealth redistributes. You do not need to like it, you need to recognize it. During 2008, the dollar fell in some phases despite Fed expansion, then later recovered in different phases as global capital hunted for safety again. During 2020, the dollar also moved in response to liquidity and risk appetite, and it recovered after stabilization. The pattern matters. Crisis management can create volatility, not only straight-line outcomes. So if you are building a mental model, stop thinking in simplistic headlines like printing money causes currency to crash forever. That is not how reality behaves, it is how narratives behave. In reality, the currency can weaken during the fear phase, then strengthen when the world decides it needs liquidity and safe assets again. That oscillation is painful for regular people because their savings and budgets do not oscillate with grace. Your rent payment is not scheduled for the next oscillation. Now, let us talk about a forced timeline. Late June is a key stress point. Around that time, the debt maturity pressure peaks. If markets are already fragile, the act of refinancing at higher yields becomes a trigger. That trigger can accelerate risk-off behavior globally. Then, depending on political and policy choices, pressure can reappear in subsequent months when additional policy constraints or tariff events or legislative negotiations collide with market pricing. In 2026, you do not have the luxury of ignoring multiple